This is a bonus episode of the Rental Income Podcast. And now, Dan Lay.
There's some pretty big differences tax-wise between regular long-term rentals and Airbnbs or other types of short-term rentals. And what I wanted to figure out on this bonus episode today is what the differences are, how they're taxed differently, and see if there's any strategies that we can use to save some money on our taxes. Joining us on the show today is Ashish from InvestorFriendlyCPA.com. You may remember Ashish. He's been with us a couple of times in the past. A lot of this tax stuff can be pretty complicated, but what I like about Ashish and why I like having him on the show is that he really breaks things down in a very easy to understand way. So let's take a really quick break. We'll thank our sponsors. We'll come right back and we'll talk to Ashish. I want to let you know about a really easy way to track your rental income and expenses. It's an accounting software custom made for rental property investors. It takes just seconds to enter an expense or to record that you collected rent. It makes tax time really easy. Just run a report and give it to your tax person and you are done. They're currently offering a free 30-day trial. There's no credit card required, so if you don't like it, there's nothing to cancel. You can learn more and sign up today at rentaltrial.com. That's rentaltrial, T-R-I-A-L, rentaltrial.com.
Rental Income Podcast.
Ashish, so let's start with talking about what a short-term rental is in the eyes of the IRS.
IRS defines short-term rental as average day, of stay from tenant is less than 7. Okay, that's what the short-term rental is. So most of the Airbnbs and Vervo will qualify. So when I say average, you can have a tenant who stays, 14 days, and you might have a tenant, 3 tenants who stays 1 day. So average would still be less than 7 days.
Okay,
that's what the short-term rental is.
And then taking it a step further, then when you have, say, a traveling nurse where you're getting people that are staying for, say, 90 days on average, how is that different tax-wise?
So those 30 days, 90 days are exactly the same as long-term rentals in the IRS eyes. So all the single-family house where you are, just renting it out to traveler nurses, those are exactly the same as long-term rentals.
Okay.
No difference.
Gotcha. Okay. So then tax-wise, how do long-term rentals and short-term rentals get taxed differently?
This is how it works. Long-term rentals and short-term rentals, they're taxed exactly the same way, but the benefits of depreciation and losses can be harnessed differently. That's the only difference. So what do I mean by that? Let's talk about long-term rentals. And we have talked about this before. Long-term rentals will always be passive unless you can qualify as a real estate professional. If you don't have that rep status, the losses that we can harness from long-term rentals cannot offset your other business income or W-2 income. And we have talked about this in the other podcasts before, right?
Right.
So that's where the long-term rental sits. Now, short-term rental, how it works is it's still a real estate, but IRS has an exception when it says if you rent out your house less and on average less than 7 days, then it qualifies as short-term rental, and short-term rental are not rentals. And that's very weird, right? It is a rental property, but from IRS perspective, it is not a rental. Now, what that means from tax perspective is if you manage your material participation on that activity, you can harness the losses and use those losses against your W-2 income or business income without qualifying as a real estate professional. So to summarize what I just said, I know it's very confusing, is for long-term rental, all the losses are always passive unless you qualify as real estate professional and meet those complicated rules. Short-term rentals, you don't have to be real estate professional to release those losses. So you can manage your participation on your short-term rental, and use that losses to offset a lot of your taxes. And that's how it's different from taxation perspective.
Okay.
Does that make sense?
Let me make sure I got this right. With a short-term rental, you can basically erase income from your W-2 job, but you can never do that with a long-term rental. Am I thinking about this right?
You are thinking it right, but the only difference is you can do that with long-term rental too, but you have to qualify as rep status, real estate professional status, which most of the people find very hard, meeting that requirement unless you're doing a full-time in real estate.
Right. Okay. And we've talked about this before on the podcast, and I'll put a link down to that show where we go into greater detail. But maybe you can just give like a real quick summary of exactly what it means to be a real estate professional, because the rules are very strict on that.
Exactly. So, like we said, you have to be reps status for your long-term rental to help you offset your W-2 income every single year. The requirements are twofold. First fold is you have to spend 750 hours in real estate trader business, okay, being a realtor or flipper or a developer and those kind of things. The second one, which most people fail if you ever in a full-time job, is 50% of your professional, work that you do throughout the year has to be in real estate. Meaning, if you have a full-time job or you spend 2,000 hours as a W-2 employee, you also got to spend 2,000 hours in real estate, which is almost impossible. That's 90 hours work week, and people don't do that. So that's the reason doctors, engineers, full-time business owners will not qualify as reps. So even if you have a long-term rental or LP interest in syndications, the losses that you get from those long-term rentals or in a syndicated deal will never help you offset your W-2 or business income. So to fight that, the loophole from short-term rental is you can have a W-2 job, you can have another business, but you can buy a short-term rental and follow few rules of material participation. Then you can actually offset your W-2 income and other business income without being a rep status.
Okay. All right. Let me summarize that just to make sure I understand, because this does get very complicated here. So, So the real estate professional status is really meant for people that work in real estate full time. Maybe you're a realtor, or you're managing your rental properties full time. You're flipping houses. You're doing something real estate related. If you are, then you can take a loss on your rental properties, and that'll offset your earned income. Where with a short-term rental, anybody can take a loss, whether you're working real estate or whether you're doing something else. Like, anybody can take a loss on a short-term rental and have a deduction against your W-2 income.
Exactly. Without qualifying as a rep status.
Right. Okay.
That's the beauty.
Okay.
Yep.
Okay. Now, what about, is there any other tax benefits to short-term rentals?
So short-term rentals are exactly like long-term rentals. You operate in the same way. So there's nothing different. You're not getting extra deduction because of short-term rental. Both long-term rental and short-term rental will give you exact same deductions. And when I say deductions, if you were to do cost segregation on your property and harness, let's say, $100,000 of losses, the benefit of short-term rental is you can use that and offset your W-2 income. But long-term rentals, you cannot do that unless you're full-time real estate. But where I'm going with the next point is going to be a little more complicated, and I'm going to slow down. Okay. We just said that, okay, hey, if you're a doctor or engineer and if you don't meet the rep status, then long-term rental does not really help you every single year. That's what we just said, right?
Right.
But if you have a short-term rental, and if you can manage your participation on the property between years, when I say between years, I'm talking about some complicated things from planning perspective. Okay, if you can convert your short-term rental into passive activity after you have benefited from the loss the first year of cost segregation, then the second year income can be offsetted by any long-term rental or syndicated deal. And this is what I mean. I know this is very confusing, and you got to work with your CPA. But whenever people talk about, oh, you can never benefit from long-term rental if you do not qualify as rep status, is not going to be correct if you can synergize between short-term rental and long-term rental in your portfolio and manage your participation on both of the activities. Meaning, final thing is this: don't shy away from good long-term rental deal or syndicated deal, because they will help you offset taxes without even being a real estate professional status if you have a short-term rental and if you manage your participation in short-term rental. Okay. That's confusing, I know. So, we can talk about this again if you want.
Yeah. Okay. Let me make sure I got this right. So if you have so really the key to optimize your taxes is to have a short-term rental and a long-term rental or multiple properties. But if you have both short-term and long-term, there's greater tax savings than just having long-term rentals.
Exactly. Because think about this, Dan. Short-term rentals are extremely profitable than long-term rentals. They have a higher cash flow. So the first year when you buy a short-term rental, we do cost segregation. We harness $100,000 loss that offsets your business income or W-2 income. Great. But next year, the property is actually going to make money. It's not like long-term rentals. They'll actually give you a huge cash flow. Even I've seen people make $100,000 from one property. Now, you can offset that $100,000 with other long-term rentals you might own, which you could have never used to offset your other income. You can use that to offset your short-term rental income, because now we can manage the short-term rental in such a way it becomes passive. So both long-term rental and short-term rentals are in the same bucket, and we can offset each other.
Interesting. Yeah. Okay. This is really interesting. Okay. Now, I know that this can be very complicated, and people probably have questions about this. And if anybody wants to maybe reach out to you to get some clarification, or if they have some follow-up, what's the best way for someone to reach out to you?
If they just type www.investorfriendlycpa.com, they'll find us. Find us on Facebook, Instagram, YouTube, Investor Friendly CPA. And my name is Ashish. They can talk directly to me. I'm very generous with my time. I help people a lot. So just email me. Email me at info@investorfriendlycpa, and I will reply back. We are very responsive.
That website again is investorfriendlycpa.com, and definitely reach out to Ashish. Like he said, he's very generous with his time. He would love to help you out if you have any follow-up questions. And I just want to point out before we wrap things up that the tax law can be very complicated. It's constantly changing. And you definitely want to make sure that you talk to a CPA before you take any action on anything you heard on the podcast today. Things could be different depending on your situation. Thank you so much for checking out this bonus episode. We'll be back with a regular interview on Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.